If you're worried about the housing market crashing but want some real data, you're going to want to watch this video all the way through to the end. And don't forget to hit that subscribe button so you don't miss any future videos. Hey, what's up everybody? My name's Dave Gove. I service the North Lake Tahoe and Truckee, California region, and I help buyers and sellers, investors and developers achieve their real estate goals. Hey everybody, I'm Dave Gove with Coldwell Banker Realty here in North Lake Tahoe and Truckee, California, and I am with
Luke Lewis with Cross Country Mortgage, helping people get into homes, finance them in California and Nevada.
Nice. Welcome, Luke. Thanks for coming out today.
Thank you.
Yeah. So folks at home, what we're wanting to unpack for you guys today is the difference between the mortgage crisis that we had and the housing crash that we had in 2008, and why that is different from today, and why you should not believe what the mainstream media is telling you about the housing market and what's going to happen.
I really believe, Dave, that part of this issue is because everyone is questioning right now, hey, is it a good time to buy? I know Dave and I, we look at the stats, and we're in a market and we're in a state that's booming, but people are asking that question all the time. Is it the right time to buy a home? And I think both of us, unanimously, all two of us, a resounding yes, it's a good time to buy a home. And that's primarily because of the investment side, but everybody needs a place to live.
Absolutely, yeah. And I, from a construction background, looking at where we are in demand and supply, we never really caught up. So in 2008, the builders stopped building, right? It cost more money. The value of houses plummeted so catastrophically because of bad lending practices that the value of a home, you couldn't build it for what you could sell it for. So if you were going to sell it for $200 a square foot, you could only get $100 a square foot for it. And then so those builders essentially stopped building until about 2014. They have not been able to produce enough inventory to get back up to supply. So demand is still outpacing supply by quite a bit.
Yeah, and that's a really good point. And that's really what led to kind of the recession. And we can track, all the recessions throughout U.S. history, but uniquely for 2008, 2009, there was a huge glut of homes on the market, and there was very little interest in people wanting to buy.
That's right. In the early 2000s, the builders got overzealous and created too much supply out there, too much product. But then what really caused this whole crisis was the subprime mortgages. So tell us about what the subprime mortgages were, and do we have products like that out there now, and what's the market doing with those types of things?
Yeah, that's a great question, Dave. A little bit about subprime. Used to be called, subprime lending, or then it transitioned into non-prime, and now today it's really considered non-QM. The QM really stands for qualified mortgage, and those are mortgages that are not backed by the FHA, they're not backed by Fannie Mae or Freddie Mac, really the government-sponsored entities. So these loans that are non-QM, they are not government-backed, so you don't really have the backstop of the federal government. With that in mind, these are usually private lenders, and also big banks, they'll do it and they'll hold the loans on their own. And what they'll allow is a little bit looser guidelines. So back in 2008, one of the huge products that was being sold, and I even had one of these, was an ARM. And an ARM is really an acronym for an adjustable rate mortgage. For instance, an ARM, they have a couple terms. You'd have a 3-1 ARM or 5-1 ARM or 7-1 ARM. That simply means that for the term of 3 and 1, the first 3 years of that ARM are fixed. Your payment won't change. However, at the adjustment period, that 1 stands for how often it's going to adjust. So in the 3-1 ARM, it'll be fixed for 3 years, and then it'll adjust every year after that, depending on the market. You can see how that's problematic. If someone had purchased a home and they go in and they've bought it and they are sitting on their mortgage for 3 years, and by the time that 4th year comes, the rate is significantly higher, it can cause pretty much a conundrum, because if your rate has gone up to the Fed rate at that time and is accelerated and has gone up 3% higher, that really puts the buyer in a really tough position.
Let's run some simple numbers on that just so that you can understand it at home. So let's say, for example, you have $1 million house, okay? In our area, that's just kind of an average home these days. And you put 20% down. Okay, and then you have a mortgage payment, an interest rate of what, 5.4?
Yeah, let's say 5.25.
5.25. Okay, so what does that give us for a payment?
That's a monthly payment of $4,742 on principal and interest.
Okay, so now if you had a 30-year fixed at that rate, you could predict that your payment would be that payment every month.
Yeah.
Now, let's say it's a 3-1 ARM, and we're adjusting now, and it was going to adjust to...
Now, let's just say it adjusts from that 5.25 to say, we'll go conservative.
Okay.
8.875.
Okay, what does that do to your payment?
That puts your payment now at $6,690.
So roughly 50% bigger monthly mortgage payment.
Yeah,
right.
Exactly. And so you can see why that would cause a market problem.
Right.
Some of these clients, they were getting into these loans, not really understanding where their payment was going to go. And that's what they've done in the Dodd-FRAN Act. They put all these restrictions on them to make sure that people were aware and make sure that people had the ability to repay. Now, what they've done differently is now these non-QM products, these non-QM lenders, they've made the qualifying a little bit more open. For instance, if you were going to have a loan backed by Fannie Mae or by Freddie Mac, you have a debt to income ratio maximum at like 42%. That means that 42% of your total debts are allowed to go to housing. The difference would be with a non-QM, they've made it a little more lenient. Some non-QM lenders will now allow your debt to income to go up to 50%. And so you're pushing your limits a little bit. You're pushing your comfort and you're pushing up your monthly payment. This is allowing more people to get into the marketplace.
Got it. So back in 2004, when did the Dodd-Frank Act go into?
2009.
2009. Okay, so the Dodd-Frank Act was in 2009 after we were trying to unpack our way out of this crisis, and we had to look forward for a path to make sure that all the underwriting and the lending was basically safer, yeah?
That's right,
yeah.
Exactly right.
Okay.
It was a safeguard to protect consumer. It's a Consumer Protection Act.
So in the years and months leading up to the 2008 crisis, would it be fair to say that most of those loans out there were subprime, ARMs? And I mean, an idea of like what percentage it was?
There was a large percentage of them. I think the stats were around 18 to 20% of them were subprime loans. But when you look at them compared to who defaulted, of those, 18 to 20% that were subprime, they accounted for up to 46% of foreclosures.
Of the defaults, yeah. Okay. And then how many of those loan products do you think are out there these days?
Well, they're still out there.
Sure.
However, as I said, the guidelines are a little bit more stringent in that these banks are very well aware of what they're hedging and their risk involved. I saw one subprime loan from way back in 2010. It had basically a start rate for the loan at 1%. And then every year it would adjust 2%. Well, you see that happening. Those kind of products, I don't really see them nowadays.
Got it. Okay. So there's really a lot more stability in the mortgage security markets, and the chances outside of a force majeure of like having a catastrophic housing crash is pretty low in my opinion.
Yeah, I agree with you too.
Yeah.
With so much demand in the marketplace and so limited supply, that is going to continue to drive purchasing because everyone needs a place to live.
That's right. So there you go. That's the difference between our current situation with what people think is going to be a housing market crash. It's not going to happen. It's not going to be like 2008. If you have any questions about real estate in North Lake Tahoe and Truckee, California, you can reach out to me directly. I'm Dave Gove with Coldwell Banker, and this is
Luke Lewis with Cross Country Mortgage. Thanks.
We'll see you next time.